All right, guys, welcome to the show today. I'm going to be introducing someone to you today. We've been teasing this for a while, so you might be able to figure this out pretty quickly. But imagine someone presenting a tax optimization strategy so powerful that it got Mr. Money Mustache to bolt upright out of his chair and say, "You are my accountant." I am so excited to introduce to you the wealthy accountant. He is here on the show, and today we're going to be talking about tax optimization strategies. Welcome to the show.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, we're back in the studio. You know, guys, I always say it's hard to win if you don't know the rules. And today we have the wealthy accountant in the studio. And Brad, I am super excited to get a chance to really go through some of his content.
Yeah, you and me both, Jonathan. This is an episode I've been looking forward to for quite some time. We met Keith down at Camp Mustache in Florida. And as many of you know, I'm a CPA, but I'm a CPA in name only, essentially, at this point. Keith is the most knowledgeable and exuberant accountant I've ever met. And that's not a word you normally hear tied with accounting. But he just loves this stuff. You can feel it when you speak with him, when you're in the room with him. He absolutely loves this stuff. And yeah, we cannot wait to really present this all to you. So this should be a phenomenal episode.
You know, and I like using adjectives in threes. So knowledgeable, enthusiastic, and I would say prolific. The man writes like 3 articles a week. It's unbelievable. And I love reading all of his blogs, all of his articles. I learned something new from every single one of them. So Keith, welcome to the studio today. How you doing, buddy?
Doing pretty good, but you got to wait a second. I'm still dancing to that intro music that you had. It's pretty divey.
Yeah, it's pretty awesome, isn't it? Now, you're actually in Wisconsin, and you're the accountant for Mr. Money Mustache, who is in Colorado. So we got East Coast, Central, and West Coast. All of our bases are covered here, right?
All the bases covered, and I have to say that it's kind of strange that I am from Wisconsin, though, because coming from Wisconsin, being the 8th highest tax state in the country, and I'm going to write a blog on how to cut your taxes, I haven't understood this, geographic arbitrage thing very well yet.
Yeah, you would think that you would just move, right?
I should. If it wasn't home, if I didn't have family here, it'd be much easier. But boy, I tell you, the climate and when the governor sends me that thing every year around April, it really gets me thinking.
There's the rub.
There's the rub.
All right, so Keith, you came on the scene. Did you start writing at the beginning of 2016?
Yeah, I started writing the Wealthy Accountant blog a little over a year ago. And how that started is I had done writing in the past. I had written some books. I've written some other blogs. None really had a whole lot of success, but it accomplished what I wanted to. Then about 3 years ago, I met Pete over at Mr. Money Mustache, and I went to see him because I had one of these business propositions. And so I had this idea. I go over to Camp Mustache in Seattle, which was the second one. And I said to my wife that I would schmooze him for a couple days, and on the last day, I'd spring this great business opportunity that I wanted to partner with him. So the first day we get there, and I said, well, as long as I'm there, I'll do a presentation on LLCs and S-Corps, things like that. And Pete shows up in my presentation, which I thought, oh, that's pretty cool. Sat straight across from me, and about 10 minutes into my presentation, he goes, "You're my accountant." And I stopped for a second. That was a tell. And when he did that, I was like, okay, and I kept on going. And after the presentation was over, he came up to me and said, when I say something, I mean I'm going to do it. I told him, I said, I had this great idea to present to you, but this isn't the direction I wanted to go. And the rest is history, as they say.
I mean, this is really remarkable just because I know that he has been, there are accountants from all over the country that have tried to get access to Pete. And it's pretty cool that, you were able to tell a story, essentially. You were able to present an idea that essentially crystallized something for him that he had not considered, and he decided to bail on TurboTax. You know, in the FI community, we are, just by our intrinsic nature, we are DIYers. You know, we're going to do it ourselves, and we're going to do it, and we may screw it up, but we're going to learn something along the way. And I'm sure Pete is probably the worst of us at that. And in this particular case, you presented an idea that so transformed the way he looked at a problem that he just said, you know what? I'm going to give this one to you.
Well, I think what stuck out in this whole presentation is that he was, and I got to make sure I say this in the correct way because I don't want to be giving away his personal information, but he was structured in a way that maximized his taxes versus minimizing it. And Pete does a lot of things himself, but he's also a very intelligent man. And you can see that by reading Mr. Money Mustache. He's an incredible individual and shares a ton of great information. Now, when he heard me speak about doing an LLC as an S corporation, he knew right away he's going to be saving money. And he knew I understood something other accountants weren't telling him. So he took to that very quickly. And we had some good conversations. The funny thing about it is people sometimes get the impression that Pete and I are chumming together all the time, and we're not. They also sometimes get this impression that every time Pete gets a piece of tax advice from me, he follows it. And that's not necessarily true. For example, when he wrote an article a few months back on donating money to charity, he was going to donate $100,000. And when he said he was going to do that, he called me first, so I knew this was going to happen. And I gave him all these great ideas to save the maximum amount in taxes. And he looked at it, he said, that's too much work, and disregarded everything I said. So he still thinks for himself, and that the do-it-yourselfer is kind of hard to get rid of.
That's awesome, man. That's a great story. So is there any way, could you give us an idea of, you know, just by making that one change, what percentage or what dollar amount? I mean, how much is making a simple change like filing as one over another? What is that worth on, not necessarily Pete, but let's just say a business that's making $400,000, $500,000 a year?
Well, it depends on the facts and circumstances. So let's look at it this way. Somebody comes into me, and let's start with a smaller business, which I get accused sometimes of always focusing on business and too big of businesses. But let's look at somebody small. Let's say a side gig, or maybe has a business that's doing, let's say, $100,000. This strategy is going to work really, really good for those people because they're going to take half of their income, or approximately, pay it as a wage to themselves. The remainder is going to come through as a distribution or a dividend through their S-Corp, and they're not going to pay any FICA tax. So they're going to save, maybe $7,000, $8,000 in tax. Pretty simple. Now, somebody comes along and they say, I'm making $500,000 per year. The problem that you run into there is they now have an issue with the Social Security cap. So you get to 120,000 or so, and then you don't pay Social Security, you just keep on paying Medicare. So that low-hanging fruit starts to go away. There's still advantages, but they do tend to be mitigated. The strategies change depending on, again, facts and circumstances. So when I talked to Pete about becoming an S-Corp, I saved him a lot of money, but part of the reason I saved him money is because Pete and his wife both own the business. They're both doing things. Things are going on. Now, that doesn't mean that each had an equal role in it. So what I did is I modified the payroll so that it reflected the reality of their business, and I was able to save them more money than originally anticipated. But for someone coming in, if they're a single owner of a business and they made a large amount of money, then my advice is going to change. So every time it's facts and circumstances.
This is awesome. You know, our audience is wildly varying in income brackets. I mean, everybody from, $20,000 to $30,000 a year to people that are making upwards of $500,000 a year. I'm convinced that every single tax bracket is represented in our audience. And to me, the cool thing about what you do and living inside the margins of the IRS tax code, essentially, is that you've been forced, due to the nature of your job, you've been forced to figure out how to optimize each one of those situations. And then if we can just turn that into a conversation, how many people can benefit from that information? It's just by them knowing the rules. And how much peace do you have knowing that you have optimized it as best as you can for your specific situation, as opposed to not knowing and just hemorrhaging unnecessary dollars?
Well, let's look at this even a little bit different. Let's take a look at this from a current standpoint. So I know this is a podcast. I know that we are recording today, but it will present in a few weeks. I also know that people down the road will be listening to this. But I think currently in 2017, a big issue is tax law change. And as we're recording this, Yesterday, the president said, I'm going to change the tax code. I'm going to have this big tax cut. And a lot of people have questions on that. Now, people that are asking the questions are making valid questions, but the questions are there because they don't understand what's being presented, and that's because it's vague. It's still in its early phases, and almost certainly will not make it through Congress. But I think that what we need to consider, and every business owner especially, whether it's a side gig, big business, small business, the idea is that we're going to get taxes down to 15% versus 35%. Now, why is that important to the small guy? So if you're a big corporation and your top tax bracket's 35%, it makes a whole lot of sense. But if you're an S-corporation, you say, wait a minute, I don't pay any tax. I pay income tax on my personal return, but I don't pay tax on a business level. What's being proposed is taking those distributions from an S-corporation and capping those at 15%. That would be massive for almost every business owner. But if you have a partnership, it's probably not going to work, as I currently understand this proposal. So I think everybody needs to keep their eyes and ears open. I think that there will be some tax law changes. I think businesses have some opportunities. And you always have to be fluid with taxes because the rules change, the tax courts change the rules, interpretation. And in 2017, I'd be surprised if we don't get some kind of tax reform, though it may not be as draconian as anticipated.
This is awesome. I bet you there's a large percentage of our audience that has no idea what you just said, but at the same time was incredibly excited by what you just said, because the idea there is if you know the rules, or at least you know who to go to who knows the rules, you can win. And that's what we're trying to do.
The rules for business are, of course, a lot wider. So I have a lot more opportunity if you have a business. I want to make sure that in this conversation, in this podcast, that we touch on the business end, but we also talk about things that are business related that people don't always think of as being business related, and talking about some personal things you can do to maximize your tax efficiency and just hasten the ability to retire, which I define as being able to do what you want, not necessarily quitting a gainful employment business-wise or as an employee.
So Keith, let's set up a scenario here, and we didn't actually clue you into this before, but I'm curious if we could talk through this. So hypothetically or not so hypothetically, Jonathan and I are starting a business, right? We're starting Choose FI. Talk us through it as an accountant, because there are plenty of people out there listening to this who are thinking about starting a business, who have just started, whatever it may be. Where would you start? So, business entity structure, things to think about. Jonathan has talked before, but like how do you get your kids involved? So potentially they can earn some income and you can dump it in a Roth IRA, or how do you get your spouse involved? Et cetera, et cetera. I'd love to hear just some real high level thoughts on that. If you think that's a valid thing to talk about.
Well, those are powerful tools. Here's what I would look at. If it's day one of a business, I'm going to ask some questions that are going to help me start the process. My first thing is I'm probably going to ask you to be an LLC, but I'm not going to ask you to be an S-Corp until after the fact when it makes sense. So it's your first day on the job, you're starting Choose FI, things are starting out. To be quite honest, you probably have a default in your LLC to a partnership. And if you say you want your wife involved, a spouse involved, that's fairly easy to do as long as they are really actively involved. They can get a paycheck. They can use all of the retirement accounts that you would ever run through the business. If there's an economic reason, which it's easy to get in most cases, for your wife to come along on business trips, I think that that's a very doable thing as well. The kids are a little different story. Now, if you're a sole proprietor, or if you're a farmer, or any of these basically single owner businesses, no entity structure, if your kids are minors, you can pay them and there's no worry about FICA tax. But if you have an entity, that rule changes because you're not the one paying them, the entity is. You can still pay them, but there can still be issues with FICA taxes and that kind of thing involved in it. So yes, you can do it where they can put money into a Roth, though it may not be as completely tax-free as you would like it to be.
Dude, I have like chills on my spine. The idea that I'm going to learn these rules as part of a conversation and I can go back and I can reference this anytime, as you build a business and as you start to flesh this story out. Very, very cool stuff.
Yeah. Now, once you get a little bit bigger, okay, now you got a couple podcasts out, this is growing, it's getting bigger. My next question to you is going to be, what is your profit? I'm not so interested in your revenue. I want to know the bottom line. When I start asking you about your income, the reason why I'm asking about income is because I want to know when I want to treat your LLC as an S-Corp. The nice thing about an LLC is it allows me to change my mind periodically. And I'm like that. I don't stick to things. I'm one of these guys. I'm all over the place. And the reason why that's good with an LLC, though, is because I can save you money with different entity structures, and the LLC allows me to do this. If you're telling me that, hey, I make $10,000 doing this, I'm going to say that's wonderful. Keep your structure as it is. It's an LLC. It is being treated as a partnership, and I really can't save you a lot of tax at that particular point. Maybe we can do some retirement accounts. If you start making $30,000 or so a year, I would think $30,000 is kind of a floor. Then if it's going to be consistent, then I want you to get this LLC being treated as an S-Corp, because now we can take some of that income, treat it as a wage, a reasonable wage, and the remainder is going to flow through to you outside of the FICA tax. Once your income goes above $50,000, I personally think it's pretty much all net at that particular time, as long as it's a business. I'm not talking rental real estate. That's a different type of business. You would not be an S-Corp ever with that. But for a business like you have, or like an accounting office, or maybe you're doing some roofing or a business of that type, you want to then be an LLC treated as an S-Corp. Now, I'm going to put a caveat in there just so people understand this. You can wait until you reach a specific marker before you make that election. So for example, I don't have to go out there and specifically today fill out all the forms to be treated as an S-Corp. I can wait until later in the year and you say, guess what, Keith? I'm doing really good. I'm making some money. It came true. It wasn't just a dream anymore. I say, wonderful. Let's fill out these forms to be treated as an S-Corp. We have a RevProc ruling that we can put in the tax return. We attach this to your tax return, even though we may file it during the year. We make sure that you act like. We want to make sure that you act like an S corporation, so we can do it later in the year and say, wait a minute, IRS, I'm acting like an S corp. I just didn't get to the point of actually filing for it. So I can look back in time and have 20/20 hindsight where I'm going to get the best tax advantage.
This is really cool, man. One of the things I want to do is just kind of as we're going, and I'm benefiting from having your article here in front of me, so I just want to put a couple numbers to it. But let's take your advice for the two different cases that we've talked about so far, and without getting into the weeds, because people can just go to your blog and they can read through this. But on a $30,000 profit-based business that makes $30,000 of profit a year, the advice that you're just now giving to us is worth about $1,800, which is pretty darn decent. And on the same line, the advice that you're giving us, if you have a business that's making $50,000 a year profit, that's worth about $3,000 just by making that one change. So you want to keep an extra $3,000 in profit, then follow your advice. And I kind of like the idea that for these different brackets where people have these side hustles, so they have these businesses that they've developed that are now earning profit. So they have a business, just by following the advice that we're talking about at extremely high level. We know this, but the idea is like you could take what we're doing and take this information to your accountant. And this advice is just saved the $30,000 profit business. It just saved you $1,800, and it saved the person that was making $50,000. It just saved you $3,000, just because for the first time you were exposed to what the rules look like inside the margins of the IRS tax code.
Right. You know, when you're in business, and I'm going to say this kind of tongue in cheek because it's not 100% true, and people will sometimes argue with this a little bit, but you almost pick your tax bracket. And what I mean by that is there's so many things you can do in a business. So let's take an example. You come to me and you say, hey, I got Choose FI. We're doing pretty good. I think I'm ready to be an S Corp, but there's a cost to being an S Corp. You got to pay for an S Corp tax return now. You have to pay for some payroll, even if you're just paying yourselves. But then you say to me, as I start questioning you, you say, hey, we bought a bunch of equipment. Okay, we bought a new computer system. We bought some new computers. We bought new software and new microphones. And we spent, let's say, $20,000. And the company that sold it to us said, we'll lease it to you as a lease agreement, and you'll pay 0% interest. You'll pay it over 3 years or 5 years. And at the end, it's a $1 buyout. So whether you pay cash now or spread it out over 3 to 5 years, costs exactly the same thing. The IRS says if it's a $1 buyout lease, you own it. That means you can deduct it right now, because under tangible property rules, every item under $2,500 is under tangible property rules just written off if you make an election. And if you have something over $2,500 under Section 179, you can just expense it in most cases, in which case I'm going to say, hey, you made $30,000. No, you didn't. You only made 10 this year. Next year we'll worry about it. So we saved you not just money on taxes, but money on some of the daily needs to be a corporation. So we can save you some money on accounting fees, payroll fees, as long as possible. So here's the thing. always keep it as simple as possible until you have no choice but to go forward to get that tax benefit.
Hey, Keith, real quick, since you talk about obviously the facts and circumstances being different, let's just say hypothetically, because a lot of the people, like I'm really trying to put myself in the shoes of someone who's out there listening to this podcast and is thinking about starting a business, right? So let's just say hypothetically they make a good salary at their job. They're even over the FICA cap, right? So they're making over 120K. Is there value in the S-Corp election then? Or does it go away once that individual has already reached the cap?
Well, it doesn't go away because there's still going to be that Medicare portion, which is 2.9%. Okay, because remember, if you work a job for somebody else, you pay 1.45 and your employer pays 1.45. When you own your own business, your employee and employer, you pay 2.9. So you save that. The second thing is it's much more clear to once you become an entity and elect to be an S-Corp, you can now have an office space. So you might be doing this, let's say, out of your home. You say, I have this business. I want to keep expenses low. So I'm going to have an office in the home. Now, you can rent your home from yourself. Now, I want to be clear with this. If you say, I got, in quotes, an office in the home as a sole proprietorship, it needs to be regular and exclusive. Those are the words the IRS uses. That means that if you have a separate bedroom used only for business, you can take that pro rata share of all your expenses in the house and deduct them. You will avoid FICA taxes on those. Everybody's happy. But I hate the rule because you can't use a corner of the living room. You can't use a corner of the basement. It has to be exclusive, has to be regular. And I'm limited to only the actual expenses. Now, if I'm an S-Corp, an LLC treated as an S-Corp, what I'm going to tell you is you need to rent your office space in your home to your corporation, to your entity. So you charge a fair rent. So let's say your deduction as a home office is $2,000 per year, but you might be able to say a fair rent is $500 per month, $6,000 per year. So now you've rented your home or your office for the benefit of the employer. It doesn't have to be regular and exclusive. It has to be for the benefit of the employer. Much easier hurdle to jump over, number one. And number two, instead of avoiding FICA taxes on $2,000, I now have $6,000 of deduction. But you'll say, wait a minute, Keith, that's crazy. I'm an S-Corp. I'm already avoiding FICA taxes in that. But remember what I said, you have to pay a reasonable wage. Safe harbor for a reasonable wage is 60%. Now, you might be able to get away with less because of facts and circumstances, but as a one-man army, 60% is a pretty nice place, or at least minimum 50-50. 50 in payroll, 50 is a distribution. Now, why is that important? If I have a bigger expense for my rent of my house, I have a smaller profit, and my safe harbor just went down too, which means if I'm making $100,000 a year, I just allowed myself to reduce my paycheck by $4,000 and avoid another level of self-employment tax.
Wow, dude, that's a game changer. And I have been looking at the home office deduction, trying to figure out what I would need to do it. And it's regular and exclusive. It's kicking my tail. Just absolutely, when I dig down into the weeds on what that actually means, it's like, I don't even know what that would look like. What you're describing is a completely different and much less stringent application of tax law if you do it the way that you just described.
Absolutely. And anytime I can do something in tax code where I can simplify the process, lower the bar, I want to do it. Now, keep in mind, there are also some other rules too. So let's say if you have an office in the home, regular and exclusive, there used to be only one way to do that. You plug in all your expenses, mortgage interest, property taxes, utilities, you get a pro rata portion. There is now a safe harbor where you can get $5 per square foot up to 300 square feet or $1,500. There are some advantages to doing that. However, I like the idea of self-renting because I like my landlord and my tenants when I'm on both sides of the trade. Yep. And everybody in this FI community knows that you need a couple rental properties, right? That's where the money's at. Well, there's the biggest problem with that whole concept is that you got to deal with tenants. And, I can't think of a better tenant than me. I always pay myself. I don't get it. And keep in mind that these are powerful tools. The office in the home is also an audit trigger. But if you're renting, it's not an audit trigger.
Oh, that's so cool.
Because it goes on a different line. The IRS computer doesn't say, oh, you're renting from from yourself. On your tax return, I'm going to check a box saying self-rental. It will affect passive activity rules, and I would expect people doing this.
I guarantee you that there's like probably close to 600 accountants. They're going to get a phone call next week asking them what the implications are for just because of the seed that you just planted.
Actually, what happens is the accountants call me. Nice. I get a lot of accountants and a lot of emailing and calling, and I'm good with doing that because I'm one guy and I have no intentions of expanding my business size. I'm one location. I don't want to be this big, massive company, but I love tax theory. I love the training. And if I can teach an accountant, they can then help their 1,000 clients. And I think that's good for their community, this country. It's good for everybody.
Yeah, that's really cool, Keith. And just mechanically, since people are out there listening to this and want to know how to do this. So you're renting this portion of your house back to yourself. I mean, do you recommend to your clients that they write up contracts, that they physically write checks every month, that they somehow get an appraisal for like what is a standard rent for X number of square feet? Like, how official do people have to make this?
Well, this is how I do it. And I talked to the IRS on more than one occasion and got pretty much the same answer every time. And here's the way it goes. It needs to have a formal contract. However, since I'm probably not going to sue myself, the contract can be written by me. So basically my contract reads, I, Keith Schrader, hereby rent my office for this amount of money per month for the next 5 years. It's a commercial lease, so it's a 5-year contract. And I'm going to pay myself on the first of the month, and that's just the way it is. It's a triple net lease. Sometimes it's not. It depends on, again, facts and circumstances. In my office building here, it's not in my home, so it is a triple net lease, and then I pay myself. Now, should I write checks every month? Yes, you have to make it look like it's a real transaction. It can't be something that you're just playing games, just trying to reduce your taxes. Do it by the book. I'm renting as an entity. Okay, an entity is a person in the eyes of the law. You would not stiff Joe Smith down the street that you're renting from, so don't stiff the entity that's renting to you or vice versa. So write it up. You sign as landlord and tenant. You date it. You write a check every month. You put it in your accounting books, and you clearly specify. So for me, I have an office building, but what you would do if you had an office in the home, that you would specify what was needed. You need to provide a room or a place for doing podcasts where it would be quiet and we can do these recordings, and a place to store certain equipment. So you want to include something, but you're going to put this in one page. You don't have to go through a whole bunch of things saying, hey, if you sue me, you got to use California tax law or California courts. What you have to say is what you need to cover. And I think as long as you have that, you've covered the bases. It may not stand up in court, but it doesn't have to. It has to stand up in tax law. And tax law says, what are you agreeing to? And what I agree to is pay me X amount of dollars per month, and you provide a certain environment for doing this work, whether it's out of your home or if it's a separate office building.
Two ideas come to mind. I'm just thinking of two other scenarios that might be fun to talk about. One is, let's say you're making $200,000+ a year and you're as an employee. What would be the implications if you restructure that as a consultant? And have you seen anybody do that?
I've seen a few people do it, generally because they came to me through the Money Mustache blog. I like the idea. Now, a lot of people won't do it because the employers won't do it because they're afraid of the fact that somebody's an employee and they have employee taxes, there can be issues. But if somebody says, I'm going to quit my job and I'm going to work to you as a contractor and I'm going to have other clients, I think it makes a lot of sense for a couple of reasons. One, I'm going to have you as an S-Corp pretty quick. I'm going to have you renting part of your home to this entity pretty quick. I'm going to have you doing the things that maximize retirement accounts. But the nice thing about it is you know as well as I do that if you work a 9-to-5 job, you don't need 9 to 5 to get the work done almost always. There's a lot of dead time. The employer pays you to be there those hours, and you're going to be there. But you know you can get the work done faster, especially if you own your own business. You can do things to increase the efficiency. So it took 40 hours a week, now maybe takes 25. Now you can bring on a new client. I think it makes a lot of sense. And people that do it, I think, have generally liked it because you can work from home in most cases. And I think, and you will, and I'll get you to pay a little less tax.
All right, Keith, one thing that's really important, obviously, to many people in the FI community is 401k savings, retirement savings, tax-deferred savings. What do you recommend? So someone comes into you, whether they're a regular W-2 employee or what we're talking about here, probably more specifically of a small business owner or someone looking to start a small business. Where do you get them started with retirement options?
Well, because we're talking a lot about business, I'm going to take a little segue into people that work for somebody else and then come right back to the business. And this has come up in the last couple of days as I've written my blog, and I've had people questioning if it's even possible. And the answer is, for tax law, it is. And here's what it is. People will come in and say, well, I don't make $100,000 per year. So I use the example. We have a couple. They make $100,000 a year, $50,000 each. Very typical in many parts of the country. People don't always make $500,000, but a lot of people make $50,000 to $100,000 per year. And I say, what you need to do is save half your money. And if you save half your money, you're going to get a lot of tax breaks for it. In fact, you might even qualify for things like savers credits or earned income credits, which are harder to get, but you can get a lot of credits available to you because your income technically is being reduced by this. Now, what you're allowed to do is you can take like a simple IRA, but if your employer just is larger and has a 401k, if their plan administrator allows it, you can take the first $18,000. And you can add $6,000 to that if you're 50 and older. So you can take this first $18,000, put it into your IRA, get your matching. It's totally deductible. Most people think it's like 15 or 20%. That's not true. The other thing people get confused on is this 25%. They'll say, well, I can only deduct 25%. The rule for a 401k is your employer can only make matching to employees that equals or is less than 25% of the money that's being put in, 25% of wage max. So what that means is this: if you're a sole proprietor, you have $100,000 and you're an S-Corp, you have a small business, you come into my office, you got a $50,000 W-2, a $50,000 dividend. You say to me, how much can I put in my 401k? And the answer is you can put $18,000 as being withheld from your paycheck, and then $50,000 times 25% is $12,500. So you can have matching from your employer, yourself, $12,500 plus the $18,000. So you can put $30,500 in yourself. If your wife or your spouse works for you, they can do the same thing. So on a $100,000 income, if you use an S-Corp, we may not even want to use the S-Corp advantages because we want to use these retirement advantages, because I can probably get as much as $61,000 between two people. The maximum that you can do per person, though, is $54,000 per year. In 2017, if you're an old codger like me, then you can do another $6,000, you can get up to $60,000. So each individual is going to do $30,500. They're below the 54, and they get to match that. So the company that they own will put money into this, and they will save FICA tax as well as income tax on that.
So it sounds like you're saying when you combine all of it together, that's all going to go in pre-tax. If you take advantage of the way that these business entities are structured, you're going to be able to get all of that profit into those retirement vehicles pre-tax using the framework that you just created.
Yep.
Very cool.
If you're willing to pay the price by cutting your spending and you want me to get money into this, you have $100,000 income, you get two W-2s, so your S-Corp is paying out 100% of the profit to you and your wife or your spouse. You max out the retirement accounts, you got $61,000 between the two of you in it. Your income for the savers credit caps at around $60,000, but because you take your contribution to your retirement account, your income is only down to like $40,000. You now actually get a savers credit, which further reduces your taxes, which means you put in $61,000, but you really didn't lose $61,000. The government handed you a check and say, it's on us.
This is where I inject #boom, welcome to Earth. That is freaking awesome, man. That is so cool. That's like, the thing about it is, this is the FI community. We've already made the decision that we are totally willing to sacrifice our income to buy our freedom sooner. And you just laid out a plan that I don't see anybody talking about on a blog except for you. I understood it. And you know, a lot of us probably didn't understand it the first time, but you know what? This is recorded, man. Go back and hit replay, listen to it again, dream about it tonight, and then tomorrow go take action. That's freaking cool, Keith. Thanks for sharing.
And let me add one more thing. Your employer is frequently going to have forms that say, hey, you can put a certain percentage in. Talk to your HR department. Your HR department will tell you if you can just go dollar for dollar. It acts like a simple IRA up to $18,000 then in 2017. What that means is that they may have a little secret in their plan documents that nobody even asks about, and you can max this thing out and just absolutely smoke it.
That is so cool. All right, let's talk about two other just fun scenarios. Let's talk about kids, man. Let's talk about having a small business and kids. What does that look like?
Well, like I said originally, if you have kids and you have an entity, the issue that you have is that the entity is paying them and the entity has to withhold taxes as if it was anybody else as an employee. However, let's say you have a really small little side gig. So farmers, it makes a lot of sense for farmers. They generally don't have any entity structure. They're running a small family farm. Or let's say you have a business that does, let's say in the summer you have a lawn mowing business. You have $30,000 a year that you make and you want to pay the kids. Well, in this case, I'd probably just say, why not go ahead and then do it as a sole prop? I would have to check the rules to make sure that an LLC that is disregarded as a sole prop can do this. I think they can, but I'd have to double check that. And what I would say in those cases, though, is that your kids then can get paid for doing work. And I have a little farm. There's a reason why I grew up on a farm and I still have one, because I can put my kids to work, number one, which teaches them a valuable lesson. I can pay them and tell them, by the way, Dad's keeping it, dropping it into your into your Roth IRA. And so I'm giving them a good start in life as well. But it does not work quite as clean if you have a S-Corp.
And let's talk about real estate just for a second. Maybe some real high level stuff. Real estate's fun. A lot of our community overlaps with the real estate community, and rental properties are big. What are a couple FI hacks that we could talk about for that space?
There's going to be two FI hacks that I think some accountants are catching on to one, and the other is definitely being dropped by almost every accountant, and it drives me insane. And the first one is the tangible property rules. The tangible property rules are probably the best thing that's ever happened in my 30 plus years in practice. The IRS actually did something that really makes sense to my clients. And you have to step back and understand why. If you're a business, you can take a large dollar amount and expense it under Section 179. If there's a profit, you can say, hey, $100,000, out she goes. But a rental property cannot use Section 179. So that $800 refrigerator is now going to have to be depreciated over 5 years. Now, that's really kind of a pain because your cash flow is all over the place. You have cash coming in, you're spending the money, but you're paying tax on money you no longer have. Tangible property rules say this. First part of the tangible property rules say anything under $2,500, you just make an election. It's on all the tax software. You just check a little box saying, hey, under de minimis rules, I want to follow those. Anything $2,500 or less, don't worry about it. Write it off. It's not a problem. So you want to do that. Two reasons. One, you get a deduction up front, and two, you clean that depreciation schedule, which is irritating. The next part of this tangible property rule is people don't understand what is depreciable and what is deductible. So here's what the rules are. Some things are really a repair expense. So you go into your real estate property, your rental property, and carpet's a 15-year property, doesn't last that long, so I tend to depreciate it less. But most of the time, if you have a rental property and you have carpet and you rip out old carpet, put new carpet in, you have not improved that property. You've brought it back to the level of which it was originally purchased. Therefore, it is a repair and it is currently deductible. If you do the same thing with windows, a window out, window in, deductible. You pull out the sashes, IRS tax court says it's an improvement. Roof shingles off, roof shingles on, deductible repair expense. If you take some roof boards out, the tax court said, well, that's kind of an improvement. Here's where it doesn't work. You can't go out there, buy a property in tough shape today, go in there and do a remodel on the thing and say it's all repairs. Doesn't work. You have to have a couple years in there, ideally at least 5. Now, there's one last repair expense hack that you can have. Even if you're doing an improvement on a property, commercial property, rental real estate, if it's under $10,000, you plug the thing in just like you normally would in your tax return, check a little box saying, I'm making the election to take this depreciable or this improvement, and I want to treat this as a repair expense. And then you just run it right through on a repair expense, take the deduction, and none of this crazy other stuff that you have to wait 27 and a half or 39 for commercial to depreciate. So that's the first part, tangible property rules. Most accountants get most of that. The one that drives me the craziest, because most people don't get it, is cost segregation. I wrote about it in my blog, and virtually no one commented. Nobody looked at it. It did I see the whites of their eyes and they go backwards and they're
yeah. No, I've been excited about this one because when it finally clicked for me how powerful it was, my jaw dropped. For whatever reason, when you wrote it, I agree. People just didn't get it. And I hope, guys, this is a part, I know you're probably almost in shock from the amount of information that Keith has dropped on you right now, but you need to now focus on this cost segregation. All right, Keith, tell us how it works.
And this is a podcast, so you can listen to this a couple times, take it to your accountant. Here's cost segregation. And the reason why you want to do it, even if you're selling your property tomorrow. Okay, cost segregation says this: you got a building, and if it's a residential real estate property, it's depreciated over 27 and a half years. If it's a commercial property, it's over 39. Now, that's a long time. A cost segregation study says this: we bring in one of our engineers, they're in there for a couple of hours, they pull the building apart into components. This is the roof, these are the windows, this is the flooring, this is your HVAC system, and we break out those components. And there's a reason for this. Some of it's going to be 5-year property, some of it 15-year property, and then the remainder is going to be back to that 27 and a half or 39. We're going to accelerate depreciation. Now, this is where it gets really fun. When you get a property and you do this is also on improvements. When you do something, a building, let's say you pay $1 million for it, exclusive of land. So you paid 1.3 for it and $300,000 for land, $1 million for building. On a commercial, it's going to be 27 and a half years. So what about $30,000 per year in depreciation? Now, we're going to get about half, a third to half of that into 5-year to 15-year property in many cases, which means we're going to take a couple $100,000, like $300,000, and deduct this over 5 years. Now, the reason why you want to do this is because you're going to be doing this against ordinary income. When you sell the property down the road several years later, it's probably going to be all capital gain. That's your recapture. There are some instances where there can be recapture at the 25% rate. I'm going to throw out this really technical thing here so your eyes might gloss. You only pay that on the excess over straight line. It's a 5-year property, okay? 5-year property after 5 years for straight line is still zero. There is only ordinary recapture at capital gains rates. So what this really means is today we're going to take a deduction. We're going to accelerate that. And then what we're going to do is we're going to hold on to this money because it's ours and the IRS wants it someday. And 10 years down the road, 20 years down the road, when you sell, the IRS says, give us our money back, but you only got to pay half because the capital gains rate is about half, depending on facts and circumstances again, of what the ordinary rate is. So you get to keep your money now. And when you do pay them later, half price.
So let's attach like a number to this. This starts to really work once you're talking about a building that's over 300,000, right? Is that a fair estimate?
Yeah. We can get down to about $250,000 now, and that's exclusive of the land. So a $300,000 building, $250,000 for the building. Let me add a few more things to this because there's a more important point. Even if you never sell the property and you do a cost seg study, let's say the roof is valued at $40,000 and it's depreciated down to 20, and now you put a new roof on. Well, I already told you if you just shingles off, shingles on, take a deduction for the whole roof, that's good. But remember the $20,000 you haven't depreciated? You get to take that right now, even though you didn't sell the building.
That's cool. So a $20,000 tax break.
Right up front.
That's amazing.
So let's go to $1 million building after land, so it's an easy number. If 30% of that becomes 5-year property, that means $300,000 is going to be deducted now in 5 years versus over 27 and a half or 39. If your tax bracket is, let's say, 33 1/3%, I know that's not a tax bracket, but let's say for easy figuring, that's $100,000 in tax savings the first 5 years, and we haven't talked about the 15-year property yet as well. So we're talking serious money.
And so this is like, let's describe, this is the person that has the 10-unit apartment complex.
10-unit apartment complex. This works for business owners. So understand, this is where accountants get sometimes confused. And this tax season, I've had to educate a few of them, and they were good with it. They did the research, but they wanted to bounce it off me. And here's what they did. You have a business, like you guys got, choose FI. Let's say you got a big national headquarters doing this. You got this $1 million building. Maybe it's in manufacturing, whatever it is. But everybody knows you never put real estate inside of an S-Corp. So small business, you got an S-Corp, and you have this little partnership LLC over here. And your accountant's going to tell you, yes, but the passive activity rules say you can't deduct it because you make too much money. So you can't take the loss. And I say, no, that's crazy. You do what's called grouping. You attach a little note to your tax return. An S-Corp needs to actually make a disclosure, but the individual attaches a note to their tax return saying, hey, I'm going to group that rental property with that business. And then you check a little box in your tax return that says, I am an active participant. It is deductible 100% regardless of income against other income.
This is incredible. A lot of people are never going to understand this, but if they can get the essence of it, if they can get the idea, then this is something that they can still benefit from, and it means real dollars. But at the end of the day, there's only one Keith Schroeder. How do our listeners find an accountant like you? Like, where would you point somebody?
I tell you, the accounting profession and the tax professional, the tax professional profession has really shrunk in the last couple decades, and there are fewer of them. It is true, there is one of me. There are good ones out there. Unfortunately, the really good ones get really expensive or they get really busy, and probably both. I think that you have to Q&A the accountants. You have to talk to them. If you're going to do a cost seg study, your accountant doesn't necessarily have to look at you and be front brain with this. They're not going to do that many of them generally. But if they're willing to look it up, or if they're saying, hey, I listened to this podcast, I looked at this blog that you told me to look at. Hey, can I just talk to this accountant for a while? I'm going to charge you a couple $100 for my time. I'm willing to teach these accountants to do that because we need them to learn it. Now, that doesn't mean when they listen to this podcast, I need 600 phone calls this week. So I'm going to be very cautious with that. What's the phone number for getting the time? 555-1212 or something?
1-800-HELP.
So anyway, I don't mind helping accountants with this. I'm not trying to steal their clients. I've got plenty enough, but I can help them with some of this stuff. The 3115, the form. So let's say you have this scenario again. We're going to do a cost seg study, and you say, hey, I bought this building 5 years ago. I can't do it. And I say, nah, don't worry about it. We'll do the cost seg study, and we're going to fill out a form called 3115, change of accounting method. And we're going to tell the IRS, remember 5 years ago when I should have been doing this? Oops, I didn't do it. I'd like to take it right now. So we're going to take all that the depreciation you should have taken in the last 5 years. Remember all that 5-year property at $300,000? Well, now I got a $300,000 tax deduction. Usually is required to be amortized over 4 years, so it's not a 1-year thing. And that's there so you can play games with this because there are people like me that would. So you would have this $300,000 deduction brought forward that you didn't take. You would have to amortize it over a few years, but you're not going to lose anything. You're going to get that full value. And it's kind of nice to get that too.
Very cool.
Hey, Keith, I just want to switch gears for a quick second. So healthcare is a big one for small business owners. So let's say someone out there doesn't have a regular 9-to-5. They don't have healthcare through their employer. What do you recommend as far as the best way to optimize taxes while still being covered for healthcare?
The first thing I ask them if they're religious, and then if they are, I tell them that they need to pray a lot because in the United States, it's a sad thing that we have such a morphodite healthcare system. It is difficult for small businesses. Arguably, what you have to do is you go to the ACA website, you get your healthcare. If you're a small business running on your own, maybe out of your house, it's really small, you can take a deduction. I know what the tax code says that you're not supposed to do it, but the IRS has acquiesced and allowed small business and small business owners to get their healthcare through the ACA for themselves and take that tax deduction for that. So that's either going to be on the business entity level itself, or more than likely on front page of 1040 as an adjustment to income. So you can take that deduction. It's not going to be lost. If you have a group, it gets a little bit easier if you have more employees where you can get a group insurance plan. But I got to tell you, I don't have a good answer to healthcare, and I wish I did. I have to stutter step through it because there is no real good answer.
Yeah, that's kind of what I feared, and that's what I've noticed in my own life. So yeah, I was just kind of hoping you had a little hack for me, actually. But yeah, that's I appreciate the honesty.
If you find it, you pass it along to me.
You bet, man. You bet.
Just for personal use.
I do know there's a few people that have kind of slipped in between the subsidy gaps, right? I mean, that's kind of the only play that some people have found is just basically getting their income low enough that they are able to collect subsidies. But that doesn't work for small business owners to the same degree.
It can. So, for example, I'll give you an example of something that I did. So if the IRS is listening, take notes, and you can decide yourself if you want to audit me. I shouldn't say that because they'll be at my door.
Yeah, don't challenge them, man.
But by the way, I have an S-Corp here, and in my area, the person that does the S-Corp audits used to be my employee, so I got a little bit of pull, I hope. But anyway, what you can do is, for example, I updated my computer system here, and the system with everything together came to about $51,000. It was that same lease situation I talked about earlier where they said, I don't care if you pay cash or pay it over 3 years, you're still going to pay the same exact dollar amount. Well, time value of money says I'll take the lease, $1 buyout at the end. And the reason why that was important is because I looked it up. It was very important to me because I wanted my $51,000 deduction. I also then used every string I could pull to accelerate and deduct things. So Section 179 for a lot of businesses might mean it makes sense to buy that extra piece of equipment. Let's say you're in an earth moving business. It might be worth buying a backhoe or something and getting that full deduction up front under Section 179 because it will bring your income down enough that it may actually not just give you a tax deduction, but also give you the ability for 1 year to get some kickback from that ACA tax, the premium tax credit.
Okay. All right, fair enough. Keith, why don't we go ahead and pivot for just a second here and kind of just talk about maybe Wealthy Accountant a little bit. I mean, you're a prolific writer, and I would say probably about 15% of the stuff on your website is absolutely hardcore tax related, like what we just spent, most of the time going over, but that is not the limitations of your blog, and you kind of cover a lot of different topics. What are some other things that you're passionate about getting out to this community?
Well, the Wealthy Accountant was never meant to be a tax blog. It was meant to get people to start thinking like an accountant, and that's how you get wealthy. If you want to have wealth and keep wealth, you better think like an accountant. So it wasn't just about the tax issues and the hardcore. I think other people do it better, and many of them did it before me. But it's about living your life right. It's about making decisions financially. The advice you get in my blog is the same advice I give clients, and I get a lot of exasperated grunts and groans. People don't like to hear my simple formula. Save half your income, invest in broad-based index funds, and the rest is my opinion on how to live life well. So people don't want to hear that though. And my argument every time is if somebody comes in making $500,000, I can't save half. I say, wait a minute, I got a client making $250,000. He's doing it. Why can't you? And then the $250,000 guy comes in and says, I can't do it. And I say, I got this $125,000 a year guy. I say, well, what about him? My $125,000 a year guy comes in and he says, I can't do it. And I say, I got a $75,000 a year guy doing just fine. Next, the $75,000 guy comes in and it just keeps on cycling down. I have one client that makes $10,000 a year, house is paid for, been retired for a long time, and he's my age, same year. So he's within a year of my age, 52. And he's making 10 grand a year, never made much more of that in his life, has a house paid off, enjoys life to the max. He still spend nothing. So it's not that it's not doable, it's that you choose not to do it. All the rest is how to live life in a meaningful way. The world according to Keith. That's what it really comes out to be. And I try to tell stories that mostly are true. I try to entertain. I absolutely want to entertain. If I entertain you, I've got you laughing. I might get you to do the one thing I need you to do, which is save half your income and invest in broad-based index funds. If I can tell stories and you like me as a person, you like my writing, and you subscribe to this, it's not about having a business. It's not about an S-Corp. It's not about all these things. Because if I give you more money in tax savings and all you do is squander it, I haven't done you any good. I just a bigger pile of debt. I mean, if it's going to be this great big Hummer in your driveway instead of paying the IRS, I've just shifted one taskmaster to another. That's all.
All right, buddy, you ready for the hot seat?
I am. My seat's getting pretty warm over here.
Yeah, let it burn.
In a world drowning in debt and rampant consumption, trapped by the chains of lifestyle inflation, these questions highlight the secrets of those who have broken free. Welcome to the Choose FI Hot Seat.
Were you ready for that?
I'm always ready. Remember at the beginning I said if you hear any crackling and that's just that's my career burning. That's what the hot seat is. This is the match that started the whole thing.
That's right. The fire is spreading. That's what we always say.
Remember, you were there when it happened.
Well, that was good, man. That was deep. That was gravelly. You could patent that. All right, let's go ahead and hop right into this. We got question number 1. Brad, go for it.
Yeah, Keith, your favorite blog that's not your own.
Is there any good blogs besides my own? Actually, what I think that's a good question, but I think people need to get a paper and pencil because I don't think any one blog, including the Wealthy Accountant, is the best in all areas. So I'm going to have a couple that I think do well in each area. And, of course, Mr. Money Mustache, I'm going to have to give a high regard. I mean, he's changed my life radically in business just by having confidence in me and saying, hey, you're my accountant. If you want to talk about early retirement, I think Pete over at Money Mustache is the best. If you want to talk about investing, I think the stock series at JL Collins is the best. If you want the godfather of this industry, of this genre, I think that you have to look to J.D. Roth, and he used to run Get Rich Slowly, which is where a lot of us got our beginning. A lot of us have our roots in that. He now runs Money Boss. I think a tax blog that is really good is The Mad Fientist. And in fact, I give a shout out. He likes to keep his name private, so I'm not going to say his name. I've been on stage with him a few times. I'm going to probably meet him again at the end of May in a few weeks here. An incredibly intelligent man when it comes to taxes. I actually printed his article out for the Roth ladder, and I used it because he said it better than I ever could and made me understand it. And I'm the tax guy, for crying out loud. So I'm going to give that one. I think another one that's important for younger people, for millennials. I think Gwen over at Fiery Millennials is great to watch as she moves forward in her life toward financial independence. Military people should probably, military guy, Doug Norman started that, and his name is, everybody calls him Nords. So I think that he's good. And I'll give you two last ones. Natalie Bacon, I tend to watch once in a while, read her stuff. She is, I don't want to say she's from the feminine standpoint, but I think definitely a different viewpoint. She's a recovering attorney, she always calls herself.
That's good.
And she's very entertaining and good. And then outside the genre, I love reading Zen Habits because I'm not wired ever, but I do need to relax every so often. So Leo, I think it's pronounced Babuda, writes Zen Habits, and I've enjoyed that for many years as well.
Hey Keith, you mentioned the Roth IRA conversion ladder over at the Mad Scientist. We've talked about that in depth, and I'm curious, and the answer just simply might be no, but do you see anything evolving in any kind of you mentioned how the president just came out with a new tax plan. Do you ever see anything evolving that could cause that to not work?
Yes, I'm glad you brought that up. I didn't think of that. That is, I want to write a blog post on this. I actually have it in my queue, but I don't want to pull the trigger yet because it's not official. I think the Roth ladder goes away. It's almost a certainty it's going to go away in the next few years. They can take away the Roth ladder because it raises taxes without saying they raise taxes. And the Roth, the backdoor Roth has always been something that works in theory in the tax code because there's a loophole, but it was never the intentions of Congress to do this. It wanted people very wealthy not to put money into Roths. And now you can be making $1 gazillion a year and still in certain instances, you can do a backdoor Roth or a laddered Roth and it works very well. I think it probably goes away. I'm actually surprised it got to this point. I still like the idea, use it while it's there, but I would guess unless things really fall apart in Washington, I think this is low-hanging fruit that both parties would be happy to make go away to have any kind of tax reform at all. So if tax reform happens, I think the Roth ladder is going to die pretty fast.
Yeah, that's interesting. So you think that rises to the level, do you have any idea what kind of revenue that would raise for the government? Is it something that will even be on their radar screen?
Well, it's on the radar screen. This is easy, low-hanging fruit. It may not raise $1 trillion, but we're probably talking, orders of 10 to 20, maybe 10 billion a year or 5 billion or something.
So are there any other issues for the FI community tax-wise, since we're on this topic? I know we kind of hijacked the hot seat here, but we talk a lot about tax optimization and certainly deferring taxes with, traditional 401ks and the like. Are there any other major issues that you see, that could potentially change that would, change the calculus of how we go about FI?
I think the big change that I think was a positive was those tangible property rules, which affects people with rental real estate. And there's a lot of people that when people hit this early retirement, they want to hit FI, they can get there quicker if they have some kind of revenue stream. So real estate tends to fit the bill. It gives you a nice passive stream of income, get yourself a nice property manager, and you're ready to go. So I think that's a good thing. I think the backdoor Roth is probably the biggest negative, and these laddered Roths, but it hasn't happened yet, so you can't look at that until it does. You just have to be aware that at some point this may go away. Now, the other thing that you need to look at, though, is there are changes coming, and I think that some of those may be positive. Nobody right now is looking at appreciably raising taxes. The issue for the FI community is the same issue for everybody. It's not the tax code. The tax code is really just something you work within this framework to manage your goal of this, independence financially. The trick is, and always has been, for me to convince my clients that I'm not full of BS when I tell them you can actually save half your income.
It really is just changing your mindset and realizing that it's possible, and maybe even having just a few other people. Like we did that quote, you're the average of the 5 people that you spend the most time with. If there are people that are doing it, that are modeling it for you, and that's the norm, instead of just spending every dollar that comes in the door, suddenly it goes from something that seemed impossible to now something that you just question, why didn't I start sooner?
Well, and the other issue is too, people will say, I maxed out my Roth, or I've maxed out my 401k, I filled my retirement accounts, I'm done. No, you're not. Okay, if you make $100,000 and you're able to put $30,000 into deferred vehicles, you got another $20,000 to put into non-qualified accounts. If you put it into a broad-based index fund, again, they're tax efficient, so taxes are going to be better. But that's not the issue. The issue is I need to get you to save $50,000 if you want to retire before you're 97. People don't believe that quick enough. If you save half your income, what does it take? Like 15, 17 years to get there? But if you're saving 10, it takes like 48 or something. Mr. Money Mustache has a calculator on his blog for this. And I don't think you need to wait that long. I always tell people if you save half your income, you're probably there in 10 years. And the reason why is because your income doesn't go to zero. If you hit 10 years and you're saving and you're not quite there under the 4% withdrawal rate, that 4% rule, you don't have 25 times your spending saved. But if you have a couple rentals, if you have a side gig, you don't need as much to retire because you got some revenue coming in.
I love it.
But you just got to get these people to save something. Not, and 10% is not enough.
Yeah. All right. How about this? Your number one, your favorite article of all time. Now, this can be either one that you wrote yourself or on another person's blog.
I'm going to take my blog because I like a lot of posts by a lot of different people. The ones, I'm going to take the Wealthy Accountant ones that they stick out for different reasons. The first one is called Silent Night, and that was published on 12/23 this last year. These are all true stories. It's little mini stories packed together. Either it was so depressing, nobody commented, or they didn't care. I thought it was my best blog post ever because it was very close to my heart. These are real things that happened. And I think that was important. If not for you guys, it was important for me. I think the next most important one for me that I think was a serious blog post is Library Millionaire. And it's because I decided that I know that libraries are this great tool to live very economically, if you will. But when I started researching this, I ran across an article that the LA Library had a whole bunch of this free stuff, like free tutoring and all kinds of stuff they were giving away for free. So I started asking my local libraries if they had anything like it. Well, I spent 2 weeks. I couldn't get out of the library. They wouldn't leave me alone. They had so much great stuff. And so I wrote this blog post, and I don't know if enough people catch this, but you can get so much free stuff from the library you can lend out. And it's not just books, magazines, and movies and things like that. I mean, I have libraries that fishing equipment and sewing machines. My local library has a Wi-Fi hotspot. You don't want to pay for Wi-Fi? Wonderful. Take it on vacation. You'll have Wi-Fi 10 megabits per second or faster pretty much anywhere in the country. Free. And so I think that's a powerful post.
No, that's huge. And, we've actually had people ask us for more information on what sort of features you can get at your local library. So we'll put a link to that article for sure in the show notes so people can check it out.
If you want some humor, I throw that in. Those are my blog posts that I think they were meaningful to me in some way that I wrote.
All right. Definitely. We'll link to all those. Keith, what's your favorite life hack?
Well, the library is I think that's pretty good. I know that Jim Collins mentioned that as well. I think the FI community is very aware of this life hack, but I think there's ways to get tax-free income, and it's fun to do. It's just fun to do it. And that's the credit card bonus hack. So you guys have a little something to do with that too. It's not maybe the best life hack. After the library, there's just so many things. But people come in and they're flat broke, and they're kind of like the Dave Ramsey guys. They're coming in, they're in the water, they're drowning. They've come up 2 times. If they go down one more, it's all over. and I tell them, if we don't get rid of the credit cards, let's just do something intelligent, and you'll get some free money and you'll pay it off faster. And I think it's a great life hack that some people that have had problems need to just say, I don't need to freeze my credit card or cut them up. I just need to be a responsible adult. And let's use this to my advantage. I think it's a great life hack.
That's very cool, Keith. Have you started maximizing rewards points?
I'm kind of a funny duck with that. I take the rewards points sometimes, but I keep on turning them into cash because I don't travel as much as a lot of people like to. I do travel some, but I have more points than I have traveling ambitions, so to speak. When I head down to FinCon, I know at least one airline ticket's paid for, and I'll get my wife's paid for too, and all the rest I'll take in cash then.
Yeah, I love that. All right, Keith, let's say number 4. What was your biggest financial mistake?
Well, you guys read my blog, and I don't know if people catch this, but I'm going to tell you a story. My biggest life hack, people, you'll hear people like Pete, he'll talk about he had a business and with a partner, and it was a problem. I made a mistake. I made a lot of mistakes in life, but the one that really rose to the top was I didn't want to be an accountant at first. I wanted to be a stockbroker. And I felt being a tax guy would be my ticket into being a stockbroker. So what I did is I got my business going. And back in the 90s, HD Vest Financial Services came around and basically convinced every accountant, every tax guy in the country, you need to be a stockbroker too. So I became a stockbroker. And I learned very quickly, I'm glad I decided to be an accountant because they had like 7,000 people that were brokers back then. And in 6 months, I was in their top 100. You start learning very quickly that this is a dirty industry. Back then, what they asked me to do and what everybody was doing is illegal today. It'd put you in prison if you did it today. And here's what they did. They would have these mutual funds that would pay bonuses. So, for example, Putnam's XYZ fund this month would have a 2% bonus on it if you sold it in commission. So you'd get a little extra. Well, everybody sold the XYZ fund. That's what they did. And all the other funds they wouldn't sell. And I kept on saying, but that's not what's right for my client. Back then, I didn't have a full comprehensive understanding of index funds, but I always told people back then, get yourself a growth and income fund because these are big companies that are growing and probably throwing increasing dividends. That's where you need to be. It was my backdoor way of having an index fund that was actively managed when I was stupid. But I disagreed vehemently with the way the industry runs. And the worst part about it is if you're a stockbroker, all my investments had to go through them. I couldn't do intelligent investing. Anything I owned, they had to know of. It had to be run through them. As a result, what I thought I was going to love, it's what I thought, I'm going to be a stockbroker. 2 years later, maybe 3 max, I was done and out. And I was getting 6 figures off of that easy. In 6 months, I already had 6 figures. So I'm talking that I turned away since then. If I could have taken my morals and pissed them away down the drain, I could have had another, 5, 6, 7 million since then in cash. I just had to sacrifice. I'd have had to throw in people like Pete and you guys under the bus. That's all I had to do. And I couldn't do it.
Well, welcome to the team, man. We're glad you're here. I guess here's the last question, man. And then that kind of wraps this thing up. What would be the advice you would give your younger self?
I grew up on a farm and I turned 18 in 1982. It was the worst year of the recession back then since the Great Depression. In Wisconsin, we're still part of the Rust Belt. It was a really difficult economic environment. The 2008 recession was bad, but it didn't hit this area the way it did in 1982. Here I am, 18 years old. In the county I lived in, every single employer, 100%, wouldn't even give you an application. They wouldn't waste the paper. The answer was no. The unemployment in Calumet County back then was probably pushing close to 25%, which is very equivalent to 1932. That's what I grew up in, and I grew up extremely poor. And as a result, I worried about money and I saved incessantly, and that it helped me get to retirement much sooner. It allowed me to take like a quasi-retirement when I was 22 until I drove myself crazy, found Mrs. Accountant, and then I had to get real again.
She definitely rounds you out for sure. Much needed.
She definitely rounds me out. And I worried too much about money. And if I had to go back in time and talk to myself, I'd say, stop worrying so much about it. Just invest the money that way and start living life. And you know what? It's not just even talking to my younger self. I have to tell myself today. Because the biggest thing I get from guys like Doug Norman, which is an awesome man, had the military guy, he keeps on telling me, stop the 1 year, 1 more year thing. You're done, Keith. You hit it. And I used to make excuses, and now I just tell him, I just like what I do. And that's why I do it. And if I had to tell myself something is stop worrying so much, live a little better, and take a vacation. I take vacations, understand. But I think I learned to not like vacationing for that reason.
Well, hopefully we'll still see you at Camp Mustache again.
Oh, I'm going to be at that stuff. See, I got something to do there. That's a business. Business trips are good. Telling me to sit down on the beach and have a cold one and just sit there for a week reading a book. And I always tell people a rope and a gun because I might miss, the gun might miss. So I need the rope. I can't do it. I'm too antsy. Yeah. But that's my advice for myself.
Very cool. All right, Keith. Well, next, how can our audience connect with you and with the work that you've been doing over at Wealthy Accountant?
There is a contact page on the Wealthy Accountant. It also gets you over to my website for the business. For example, though, if you contacted me and said, Keith, I heard about this cost seg study. Do you have information? If you email me on that through my blog and contact, I'll shoot you back some contact information for the person to get in touch with. If you're a small accounting firm like mine and you want to do this work that I'm doing where you outsource things, where you do your taxes internally, but you just don't want to deal with payroll and that stuff, which can be kind of a pain. If you contact me, I'll get you in touch with people that I have actually trained that they'll actually be pretty good to do this for you, do a turnkey.
Cool. All right. I got an idea idea, Keith. I want to pitch it to you live and see how you feel about it. Two things. One, this was a lot of fun. This was great. And I know this only scratched the surface of the ideas that you have. And so, if we were going to do just over the next year or so, we were going to do another kind of 3 either short or full on segments. What would be 3 topics that you think would be a lot of fun to just, unpack on the show?
Well, I think the first thing we have to determine is what I'm going to get paid. So I figure a good bottle of Jack first would be a good start.
We'll send it your way.
Okay, so I think if we can focus on a couple of things, we can always go back to business, maybe talk about the hobby versus what a business is. So for example, people do Uber. And the average person that does Uber does it less than a year and they quit. And I argue that they're not in business. They're a hobby. And so they're overpaying their tax. I think that would be an interesting topic to get into.
Very cool.
I think another topic we could talk about is when do you know you have enough? When do you know, so for example, you get the 4% rule, but the 4% rule is kind of a flighty thing. 4% is not really what you're going to do. You're going to have some income. So when do you decide to get in and out of this? When do you decide to retire? And I had a consult this morning with a person through my blog this morning, another business owner, and he had a great topic too. He called me up. He just wanted to talk to me for an hour. He paid me for this. And he wanted to talk about things like, can you look over my businesses and things like that and tell me if it's a good deal or not? But what he really wanted to know, can I retire without really retiring? And so we talked about what I call practicing retirement, mini retirement. So guys like J.D. Roth will write that, hey, I took a vacation for a year. I traveled around the country with my girlfriend. We had a great time and we did this and I walked out of life. And my argument is that's a great concept. I love it. It actually draws me. I like that idea actually. But wouldn't it be greater if we could just find a way to take a 6 or 8 week vacation and then come back and then do it again later and then come back? You can still run your business. You can still have your job. The mad scientist, his wife did that. She said, hey, I'm going to be gone for a while. I'm going to see you later. They said, good, have fun. I think that's a great topic to get into.
Very cool. We've set up a voicemail feature and it's being used. We're getting close to 10 voicemails a week. And some of those are tax related. I was just wondering if we were to get a really good tax related question and we were to send that to you your way, maybe to send you like one every 1 to 2 months, something like that. Would you be willing to, do a response to that and just send it our way and we can play that on as a segment of the show?
I think we can do little mini shows on that. So we could have a full-fledged, let's say 2 or 3 times a year. I like using real life examples because it allows me to do something I can't do on my blog sometimes.
Very cool.
And what I mean by that is this. I go out there and I throw out this idea. It's a concept. It's not an actual real life thing. And people will then keep on emailing me and commenting, well, what about this? What about this? What about that? And they're right. There are so many different factors that can affect this. So if we had a specific situation where we say, Anonymous said, I have this situation, I can take the facts and circumstances as it applies to Anonymous and say, this is the things that I would do. Here's what I would consider. Here are the options. And I think fleshing something like that out, let's say a 30 or 45 minute quick podcast might be a fun way to use examples and then people can apply them in their own life if they have something similar.
Thank you. That was awesome.
Sounds good. Thanks for having me.
Yeah, no problem. All right, guys. Well, that brings us to the end of this episode. That is amazing. So first of all, guys, what you just heard, Choose FI has become the podcast home of The Wealthy Accountant, and we are really honored that he would be willing to just come on a somewhat recurring basis and really share the knowledge that he has accrued over the last couple decades. I mean, the guy is a wealth of information, and nobody is going to give you more accurate, more in-depth knowledge than The Wealthy Accountant, especially when it comes to tax optimization strategies for the FI community. So I hope that your mind was blown by this episode. I hope that you realize how much you don't know, just like me, and that you're going to go back and you're going to listen to this not once or twice, but maybe 3 or 4 times just to figure out what it is that you don't know and how you can use the piece of that will make a difference in your life and you can start to move in the right direction. And so, Brad, I know actionable steps is what we're all about. What did you come away with today?
Yeah, this was a great episode. I could listen to Keith all day, honestly. He is at a totally different level from any accountant I've ever met. And, that was my profession for 15 years. So that's as high a praise as I can come up with. He's operating on a different level. To me, I'm going to go back. I know I was taking notes. I'm going to go back and listen to this 3 times just about the cost segregation, all the expensing of depreciation, like that's an aspect of tax that I know nothing about. And frankly, I don't know anything about real estate investing now, but that's something that I know a ton of you out there are going to take a huge amount of value from. So, for me, that's one of the biggest takeaways. And yeah, I just want to sincerely thank Keith for taking the time. This was a really wonderful episode.
All right, guys, very cool. Well, as we always say, the fire is spreading, my friends, and join us next time as we continue to go down the road less traveled.
You've been listening to Choose FI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.